The price of an inventory can be evaluated at a standard price or at a moving average price. But deciding which one to use is a critical business decision because all the goods movements result in an update of the inventory value and also therefore the financial statements. So choosing the right price control is very important in the material master. In this video, we are going to understand what is exactly a standard price, what is a moving average price, which one to choose, what is the recommendation, is it a thumb rule, what happens if we choose a different one, everything about this. We will also see in system how the transactions on the material will impact its price control or the inventory value. So before we go into the video, as you all know that, please do like our videos if you are finding it useful, and please do subscribe. That really means a lot. It's free for you, but it really means a lot for us. And please do also share it with your circle. If you really wanted to contribute to our work, then you can click join and you can contribute to our work. In return, we will also provide you some member exclusive videos, content, coupon codes, etc. And if you just want to do a one-time contribution, please hit the super thanks button below this video. And I don't want to trouble you. Let's go into the video. So first, let's start with understanding the what concept. So what is the moving average price and what is the standard price? We'll start with the standard price. Standard price is represented by S in the material master data and it is always constant, which means irrespective of the goods movements that are happening on that material, the price of that material is not going to change. So that is why it's called as a fixed price. And where is this value coming from? This comes from the standard costing, which is a part of the product cost planning, that is a month-end activity or an year-end activity. So once we run the product costing or standard costing, the material is updated with the standard price. And from then onwards, until a subsequent standard costing is run, the price of that material is going to remain the same irrespective of the purchases or sale transactions that happen on that material master. So whenever there is a transaction happening, if the transaction is happening at a different price than the standard price of the material, that difference is posted onto a price variance account. It is not absorbed into the inventory. So that difference is posted onto a separate account, price difference account or a price variance account or a purchase price variance account, multiple names, but it is a separate GL account where we record these price differences between the standard price and the value of that transaction. So this separate GL account helps us to understand what are the variances in the purchase transactions or the purchase variances on that material. Because these purchase variances are posted onto a separate GL and not onto the material, the inventory is always valuated at the standard price, which also means that there is no concept of price variance if we are using standard price on the material. Whereas on the moving average price, the moving average price, which is represented by V, is dynamic in nature, which means it keeps on changing whenever there is a transaction posted on that material. For example, if you are purchasing a material at a price which is different than the moving average price of that material, then that difference here is posted onto the inventory. That means the price of the material is updated according to the price difference, and also the overall inventory value is also affected by that. So here there is no concept of price difference account or a purchase price variance account, what we saw in the standard price. So all that differences are absorbed onto the inventory, and hence the differences will directly impact the value and also the stock valuation. So that is a difference between a moving average price and a standard price. So if you see here, the standard price, no variance concept. Yes, because we don't have any variances. Those are posted onto a separate GL. The price is fixed in nature, and any differences in the price between the transaction and the standard price are posted onto the price difference accounting, and the price is independent of the material movements that are happening. Whereas moving average price is very dynamic in nature. It is represented by V. It is impacted by the transactions posted on that material, and any price differences are absorbed by the inventory which means the value of the inventory is closer to the real world price of that product. So how is it calculated? A standard price is calculated as the price per unit multiplied by the total stock quantity. For example, if the standard price of a material is 100 and we are having 10 units of material in the inventory, then the value of that inventory is 10 into 100, which is 1000. Whereas a moving average price, it is calculated by dividing the total stock value with the total stock quantity. For example, if you have purchased a material of 10 units at 100, then the total is 1000. And next time you have purchased the same thing, the 10 units at 200, which is 2000. So the total here is going to be the average of that, which is 1000 plus 2000, which is 3000, divided by 10 plus 10, which is 20, which is ultimately resulting into 150 per unit, and multiplied by the total quantity, which is 20 units. So it is 3000. So that is the difference between how a standard price is calculated and how a moving average price is calculated. So when are these prices recommended? SAP recommends standard price for assemblies and finished goods. So any kind of a product which is kind of an end product, that is recommended to use a standard price. And moving average price is recommended for raw materials. That means these are mostly the materials which are purchased from the external vendors. And why does it recommend in that way? Standard price, because it is fixed in nature, it helps to create a level of price stability when those materials are being used in the manufacturing process. So because of this, whenever there is any variance in the manufacturing process, system prevents that variance to flow back to the inventory valuation. So the inventory is valuated at the price at which the standard cost estimate is performed. So that is the advantage of using a standard price. And not only this, if there is any variance during the production, the standard price, because it prevents the variance from impacting the inventory value, this variance can be analyzed separately, which will also help us to enhance or make our manufacturing process much more efficient. That means, in short, it helps in increasing our production efficiency. So, moving average price, on the other hand, the reason why it is recommended for the materials which are purchased is because it's dynamic in nature and it allows the inventory value to adjust for the constantly changing purchase price. And we know that the purchase price is not in our hands. The vendor can change the price anytime, and using moving average price will help to adjust our inventory value with those price changes so that the inventory value is almost equal or near to the real world value. Otherwise, when we use these raw materials in our manufacturing process, if it is not reflecting the real world price, then the final product value will not meet the real world one and we might end up in losses. So that is the reason moving average price is recommended for the materials which are mostly procured externally. Now, is this a thumb rule? When SAP said that, okay, this is recommended, but do we really need to follow it? Not exactly. There are various countries which follow otherwise. For example, if we take a European organizations, European countries usually use moving average price for purchases and standard price for the finished goods as per the SAP recommendation. But US organizations tend to use standard price even for the purchase materials. So their raw materials and the finished goods both use standard price. So they are very conservative in nature because they wanted to track the purchase variances as well. As we know that moving average price, there is no concept of variance. If there is any difference between the moving average price and the price at which the material is being procured, that difference will be absorbed into the inventory. So you cannot exactly differentiate or cannot monitor the variances in the purchase process. So by using a standard price, the differences will be going on to a purchase price variance account. So that account will give us a track of the purchase variances happening on that material. So that is the reason many US companies tend to go with standard price even for raw materials. But that comes at a cost. Though we are having an advantage of being able to analyze the purchase variances, because we use the standard price, the materials are not reflecting the real world prices. So at regular intervals, we need to run MR21 transaction to update the prices with the real world ones. Now, how do we arrive at that real world prices? That is by running standard costing. So not only for finished goods, but we also need to run standard costing for raw materials if we use standard price there as well. So these are additional activities that needs to be performed if we are using standard price for raw materials. And in addition to these two activities, the purchase price variance account should also be constantly monitored at regular intervals to analyze on the price variances. So every price control has its own advantages and disadvantages, and that is the reason SAP recommends it in different ways. Now, the decision of whether to use a moving average price or a standard price also depends upon the industries. For example, manufacturing industries typically go with the SAP recommendation. Moving average price for the purchase materials and standard price for the manufactured materials. But whereas if you see a retail industry, typically in retail industries, the purchase variances are huge. So whenever you are selling something, whenever you are selling a garment in the retail store, the price of that changes in the market very easily and very dynamically. So they use moving average price even for the finished goods as well. So whenever there is a change on the purchase side, that will also immediately impact the price of the garment listed in the store so that they do not incur losses. So, depending upon the industry, there can be a change in how you are treating the price control of a material. Can you imagine that the price control has also an impact on the system performance? It does. Moving average price, because it's dynamic in nature, whenever the system wants to calculate the inventory value of a material that is having a price control as moving average price, SAP puts locks on certain tables so that there is no change in the values because of any internal transactions or an external transaction happening on that material. So because the system puts locks, there is an impact on the system performance, especially when there are multiple raw materials that you are issuing into the production process. Then the locks are more in number and also the system performance is taking a bad hit. But whereas on the standard price, it's not that difficult because standard price, there is no dynamic nature. So it just updates the quantity whenever you're procuring something at the same price, which is already there in the material master. So there is no concept of locks and no much impact on the performance of the system. In ERP, the moving average price used to always calculate in parallel to the standard price. Even though you put as S or V in the material master, ERP system used to update both the prices in parallel. But in S4, SAP has improvised this. It had made it more efficient. Moving average price is updated only if the material is having a price control as V. Otherwise, it is not. So that is also reducing an impact on the system performance. So ultimately, how can we select a material to have it as a moving average price control or a standard price control? There are two ways where we can select. The first one is when we are doing an configuration. For example, when we are having a material type creation, then we can decide what should be the default price control. And the second one in the material master data, irrespective of what is the default value that the system is proposing based on the material type configuration. In the material master, while you're creating a material, you can change the price control to standard price or moving average price under the accounting one tab. So we'll see in the system how exactly the value of a material changes based on the input transactions. For example, the purchase transactions. I hope you have found this video useful. Please do like it, share it and subscribe if it helps you. And if you want to see the impact of standard price or a moving average price in the SAP system right away, do subscribe to our channel, join as a member, and the next video is available for early access for the premium members and the super members of our channel. If not, please do wait some time. You will get it on the channel in some time. So see you in the next video. Until then, take care.